Hey guys, welcome into the video. Today I'm going to be breaking down one of the greatest companies in the world right now. What is that? Palantir. I'm going to be going over what's the growth of the company, what's the value, and whether or not I personally think it's justified. So, heading straight into this, looking at the stock price the past 5 years. From the low it hit about 3 years ago, it's up roughly 1900%. And that's not even considering where it was a year ago, roughly over $200 per share. That is a tremendous increase. But look here at the past year. About 8 months ago, from where it hit during the high, it's down roughly 35%. And that's not even considering where it was a couple months ago when it was just over 100. So we have this phenomenon going on with Palantir where the past 5 years have been incredible, but over the past year, we've had some headwinds. So I'm going to go ahead, break down the numbers. We're going to see what's going on under the hood, starting with the growth rate. Current year 2026, estimated 72% revenue growth. That is astonishing. And not even astonishing what it's doing this year, but look at the trend it's been doing over the past 3 years. Back in 2023, 16%, then 28%, then 56%, then 72%. This is something that's continued year after year after year. But look into the future. What's 2027? 45%, then 42%. So we're under this weird dynamic here where instead of having revenue growth go up and up and up, now we're wondering, well, it's starting to drop. How low will it go? So we're going from this incredible growth to this deceleration of revenue growth, and people are wondering, when's it going to stop? But look at the net income. Back in 2023, it was a little over 200 million. Now 3.5 billion roughly. That's tremendous. And is it going to keep going up? Absolutely. It's going to roughly double in the next 2 years towards 2028 to 7.3 billion. That's pretty incredible. Now, EPS. What are we looking at? This current year, 96% EPS growth. You do not see many companies their size doing that. And that's off of 72% revenue. So you're getting an increased EPS based on revenue, which you really like to see. But what about the next 2 years? Well, you're now seeing EPS growth being outstripped by revenue growth, which is something you really don't want to see. Is it the end of the world for this company? Absolutely not. But is it something to keep in mind that they're not getting that margin expansion? Yes. So it's a small red flag, but are they still growing incredibly? Absolutely, they are. Looking at the value, this company, Palantir, trades incredibly rich. Very, very high PEs. All the way back, even look at 2023, 190 PE ratio, forward P of 60. Wasn't as expensive, but look at 2024, 400 PE ratio. 160 forward P. Look at the PEG ratio in 2024. 6? That's pretty high. Look at 2025. Little under 300 PE, almost 200 forward PE. PEG ratio is almost 4. Still very, very expensive. This year, this current year, it has came down roughly in half if you look at like the forward P. 150 PE ratio, 80 forward PE. So it's came down a lot, but it's still expensive relative to the market. Think about a current stock or a normal stock in the market. 15, 20 PE ratio. So having an 80 forward PE, roughly 4x the market. So has it gotten much cheaper? Absolutely. Is it still expensive relative to the market? Yes, it is. PEG ratio has came down quite a bit though, 1.6. So if you put their growth in perspective, it's not a crazy expensive company. But let's look at their earnings. Now, this may be one of the best earnings you will ever see in a company in history. Maybe outside of like a chip company, think of like Micron, SanDisk right now. Maybe not in the future. Maybe for another video we'll tackle that. But you don't see in income statement this incredible. Revenue up 84%. Cost of revenue only up 24%. What does that mean for your gross profit? Straight to the moon. 99% increase in gross profit. And if we look at what were their operating expenses, oh, you might think, oh, these are up, they're probably 30, 40, 50%, right? No, sales and marketing 35%, research and development 19%, 84% revenue growth. Crazy. General and administrative only 11%. That's it. So total operating expenses up 23%. If you only got your total operating expense up 23% and you're growing gross profit 99%, 328% net income, or income from operations, excuse me. That is incredible. Net income 300%, earnings per share 300%, weighted average shares of common stock outstanding up a little less than 2%. So there is more shares coming onto the market, but is it insane percent-wise? No, it's not crazy. And if you look all the way down there at the bottom row right there, which is the stock-based compensation, that is there for a company like Palantir. This is something they've done throughout their history. It's something that has gotten better. It used to be right around 60%, roughly, is where they used to have it on a percent of actual like research and development, general and administrative. It used to be about 30% of those numbers, or it used to be about 60%. Now it's came down a little bit, about 30%. So, and this isn't added on to what's above there on those expenses at all. This is how much of that is based on stock-based compensation. So about 30% of it makes up those numbers. And just think about this. For those numbers to be where they're at, 35, 19, and 11%, with this stock-based compensation included into them, that means you have a pretty incredible company. Now, looking at the balance sheet, this is a rock solid balance sheet. Cash increased $860 million. Total assets, $1.3 billion increase. Look at their total liabilities, only up $230 million. What are we even talking about here? Cash was up $860 million. Their total liabilities were only up $230 million. That's like over a double up. That's pretty incredible. So, total stockholders' equity up $1 billion. This is a rock solid balance sheet right here. Absolutely incredible. Now, looking at my projections here, this is where you get a little bit of why this company has had issues the past year. Look at my base case. Base case projecting 30% revenue growth, 40% net income growth over the next 3 to 4 years. If you string that out, 40% net income growth, a respectable PE for a company doing that kind of net income growth, roughly 50, I would give it. So you're at a compound annual growth rate of 20%. Still good. I mean, you're roughly double what the market usually does a year. So I would say Is it justified? Yes, I would say it's justified, and I'll tell you why. Look at the bear case. This is roughly the company doing 25% revenue and 25% net income. This would be horrible for them. Say that some more competition comes into the market, margins maybe start dropping. So slap a 35 PE on it. You're down to negative. So this is basically just dead money sitting there for the next 3 to 5 years. But look at the bull case. 55% net income growth. This is probably roughly 45-50% revenue growth. Say the company actually does 40-45% net income or 40-45% revenue growth the next 3 to 5 years. Say they do 50-55% net income. Respectable PE for that, 65, I would say. Then you're up there to 40% CAGR. So this is why it's super important to run your own numbers. Plug your own numbers in here. What's the net income going to grow the next 3 to 5 years? What's a respectable PE ratio to put on the EPS based on that net income growth? And run your own numbers here. So whether or not you think they're going to grow net income 55% or 25%, you're going to get a completely different number here. So the big question, do I think Palantir is justified? Like I said earlier, yes, I think it's justified. I would say it's a slight buy to neutral in my personal opinion, but run your own numbers, do your own research, and if you guys have any more comments of stocks you want me to go over, feel free to leave them in the comments down below, or just anything you want to say, go for it. So hope you guys have a great rest of your day, and I'll see you in the next one.